Welcome to our session today on investing in sustainability. Where should the best sources of capital be invested? And I'd like to welcome our speaker, Shiva Dastar. Hi, Shiva. And will you tell us a little bit about yourself and your relationship with GCV?
Yes, hi, Amy, and hello, everyone in London. I wish I were with you in this amazing, buzzy, probably room. Unfortunately, I'm sitting here in Luxembourg. Indeed. So I'm Shiva Dustar, heading the Innovation Finance Advisory at the European Investment Bank. And I've been a loyal participant and active presenter at all the symposia of global corporate venturing in the past. We have indeed over the years developed a really strategic and complementary partnership together. And I will tell you a bit more about it later on. So again, thanks for having me and looking forward to being part of this discussion, at least virtually.
That sounds great. And what do you think the role of multilateral development banks like EIB is in investing capital?
Indeed. So multilateral development banks, as the name suggests, are sort of crossing borders. And the European Investment Bank is the multilateral development bank of the European Union. We have also self-declared ourselves to be the EU Climate Bank, which of course is really raising the bar, and we are transforming ourselves to really live up to that expectation. So what our roles are, or where really MDBs can play an really critical role, is to channel capital towards sound projects where they're most needed, tackling some of the global challenges, like right now the climate challenge, the pandemic challenge, but really both global and regional challenges, and doing so very often because of market failures. And why do we have market failures? Well, because of potentially a risk perception, or just a very high risk, because of often regulatory regimes that are not yet fully set up or coherent, because of information asymmetries. Very often investors don't really know where these projects may be. So and then there's, of course, the cross-border complexities. I mean, when you deal with global challenges, that is obviously an indispensable part of it. And we see that there also MDBs can really play an important role of connecting regions and countries through their investments. So now, how do we do that? I would maybe highlight just three areas. One is that we play the role of very often helping to develop new markets and new market opportunities by going in there earlier, taking more risk, providing patient capital that is much more mission oriented, and paving the way to then mobilize private capital down the line. And we see that, right now in our own portfolio, we have instruments like the energy demo projects and the infectious diseases financing facility. So two key SDGs that, on both on the energy and on the global health front, where these instruments can actually go into projects where, the technologies are being tested for commercial scale up, in demonstration pilot stages, very often with risk levels where the private sector would not come in. And this is sort of the role, therefore, that banks like ours can play to then help these technologies get to a stage where they can be scaled up with additional capital. The second role that we have is also develop new financial products, risk sharing schemes. We see that right now in the green space. We were the pioneers of the green bonds, which, as you know, is our $1 trillion market. But the main thing is, how do we now scale these things, or bring them also to corporate players to issue green bonds, green loans. So we are continuously also inventing and reinventing our own product suite and paving, the way for those instruments to become more mainstream. And then the third area is where I'm actually very actively involved in and heading the advisory side. It's on the one hand advising companies, promoters, to have better access to finance, to help them prepare for financing by the bank or other investors, but also, and this is where we are now going to play a much more bigger role is provide green advisory support to financial intermediaries so that they can green their own portfolios, that they can help their clients to develop new products, green bonds, and so on. And that's where the scale effect comes in.
Oh, that's great. And can you give us an example of what you're currently working on?
Yes, indeed. One of the examples I would like to mention is hydrogen. The reason for that is this is actually one of the more recent examples of our excellent collaboration with Jim and his team at Global Corporate Venturing. So in the hydrogen area, we are so again going to look at it very holistically as hydrogen. How can the EIB help develop the hydrogen economy? One of our starting points has been right now to map the risk appetite of both corporate and financial investors currently in hydrogen-related projects. And this is where GCV came in providing us consultancy support on the early stage financial investor front and what their appetite is, what would be the barriers for them to invest, what would be opportunities, where they see the risks. Now, together with then McKinsey, who helped us on a more sort of developed end of the market, we jointly sort of mapped the value chain of investments. And this is actually a report that we're still right now internally reviewing both at the EIB, but also the European Commission to really then derive the recommendations. Now, what you can see is here, and to give you a very quick sort of a glimpse of where the recommendations are leading is, they are very much giving us the perspective of there is indeed, in the case of hydrogen, a lot of the things I mentioned in my earlier answer are very relevant there. You don't have a regulatory regime that is well set up. You have a high risk perception of hydrogen projects because of the value chain, not really being well yet sort of set up. How do you get the green hydrogen to the end user, and therefore, the expectation is indeed from banks like the European Investment Bank to play that catalytic role and come into these investments earlier with long-term capital and therefore actually develop new financial instruments that allow us to share the risks better and adapt those instruments to the needs of the hydrogen economy. And then the third, again, point on advisory, that also a lot of these projects do require additional technical and financial advisory support to actually really mitigate the risks that are perceived. And all of that together would hopefully bring in the trillions, as Jim would say, into the billions of capital that the public sector would provide.
That's great. And so what would you like to hear from the other panelists today?
Yes, well, I wish I were there in person with them, but I would love to hear their view of what they see the role of public sector banks, and in particular multilateral development banks like the EIB, but also others, is in channeling more investments into the sustainability. I see that there may be a discussion on nature-based solutions. This is another area where the EIB is actually really trying to get its head around what type of financial instruments do we need to develop? How do we need to assess the bankability of NBS, projects? And therefore, I'd love to hear their view, how they see this space develop and how the EIB could play an important role also there. Thank you very much.
Thank you.
So we've all been used to just seeing people in Zoom, but we actually have the pleasure of not just seeing Amy in Zoom, she's sitting right here. So I'm going to introduce her up on the stage. Amy is a partner with Fager Drinker. She has been a practicing lawyer in the US, the UK, and Russia, has done about $6 billion in transactions in M&A, strategic finance, and JVs, and she'll be moderating the rest of the panel. Amy?
And luckily, you don't have to just hear from me today. We have Jeremy and Becky here, and I'll let you guys introduce yourselves. And so, Becky, do you want to go first?
Sure. Thank you very much for the invitation. So I'm Becky Wildbore. I'm head of research at a company called Natural Capital Research. We're a data and science-led company. We use AI and machine learning, satellite imagery to baseline natural capital, so the state of nature globally, and identify opportunities for enhancement as well.
That's great. Jeremy?
This is weird. I mean, you've had a day of this, haven't you? But this is the first time in 2 years that I'm not having someone tell me I'm on mute. This is brilliant. So anyway, I'm originally an accountant, long time ago now, an escapee accountant, and I currently work with the United Nations Development Programme on what we call the SDG impact standards, which are a set of standards for private equity, bond issuers, and enterprises. And we have one with OECD on the development aid community, which are management standards, really, which assess the organization's ability to be creating what we describe as a positive contribution to sustainability and the SDGs. And my role is to create an assurance framework for that, so that we have assurance as the UN that that is all happening in the interests of effectively people's human rights at the rate which we need to deal with them before we all drop off a cliff.
That's great. And so we're going to switch gears a little bit today, and we're going to talk about in sustainability and investment, how to avoid greenwashing. So I think the first question is, what is the issue out there? And so, Becky, why don't you start us on that?
Yeah, I think we were having quite a heated discussion before the session started and getting quite animated about this, because I think, let's start with a controversy. It's good to have a controversy on a panel. So we heard at the beginning that a lot of people feel like the biggest challenge that is facing humanity at the moment is climate change. And I wouldn't disagree that it's hugely important, but actually there's a much wider issue here, that a much bigger threat to humanity, I would say, is the collapse of ecosystems and biodiversity. And it's not necessarily something which is being discussed at the moment, and we'll talk about this in more detail, but I think one of the issues around the E in ESG is a very narrow focus on just climate, just carbon, and getting caught up in that, and therefore missing, I think, a lot of the impact, negative impact that you might be having on other elements of nature. And we know that the data and the science are catching up very quickly, so I think there's a real risk of being caught out and being seen to be greenwashing because you feel you're sustainable on climate, but actually you're very negative on biodiversity, on water quality, on plastics, pollution, that kind of thing.
And Jeremy, your
Contentious. I agree. One of the big ones for us is that we get selective SDG picking. So the number of organizations that will go, we're making a contribution to SDG, pick a number, but ignore all the other ones, and therefore consequently do not know what impact they're having on the other ones, which may be significantly negative, and the net effect of their small positive on one may be wildly offset by the effect on the others. And unless you get a more holistic, I mean, my particular concern with this is SDG 10, which is inequality, and the risk that we are having significant impacts on widening inequality as we run doing other things. It's also an issue, clearly, because I think 50% of the climate change is caused by the 10% richest. So inequality is not just a poverty issue. We have SDG 1 for poverty and SDG 10 for the wider inequality, where we have to recognize that we're all part of the problem on that. I remember going to, I think one of the first impact investing conferences in London some years ago now, which was run by what is still now called the Global Steering Group for Impact Investing. And a member of the audience stood up and said, there will be no audit of impact over my dead body, right? And which is quite an extraordinary thing to say, I think, because we live in a world where better or worse, we're all quite used to somebody auditing our financial statements. And as investors, we absolutely need that assurance if we're going to have the confidence to invest in other people's businesses where we may never meet the managers. It's an amazing creation, effectively, that we've achieved. But it's very strange that when we talk about green or SDG or impact, it's suddenly like, should we be doing assurance even? Do we need it? What's it about? Whereas it seems to me like it's a kind of, if you don't have it, you're in marketing, basically, and not in a statement of your contribution to sustainability.
And it seems like there's an issue around how do you measure it? What should you be focusing on? I mean, do you guys see this as one of the issues as well?
Definitely. I think particularly, so I'm just going to speak about the E, that's what I know, but in terms of environmental impact, there's a lot of uncertainty and a lack of data, good quality data, I think, about the full range of impacts that people are having on the environment. And that's what we try to do, is to fill that gap, that information gap. I think there's a risk that you feel that you're doing the right thing, you try very hard to do the right thing, but either you're using the wrong metrics, the wrong data, or that you're not thinking widely enough and thinking about your impact widely enough. But we know that the data is catching up very quickly, and the science is catching up very quickly. So I think if you're not, my advice would be, if you're not aiming at the very highest standard now, then I think the likelihood of being caught out is quite high as the science and the data catches you up. So I think you really want to be aiming for the best of the best standard to make sure that you are, doing the right thing.
Yeah, I think it was a couple of weeks ago, the Bank of International Settlements came out with the fact that they're now concerned there's a risk of a green asset bubble, of the kind of scale of the asset bubbles we've had in the past as money has poured into those markets, but also in the expectation of related higher financial returns along with doing good things. And because of the risk within the data, there's a risk that actually that isn't going to happen, and that is quite a significant financial risk, let alone the fact that it means we also will not be having the environmental impacts that we want. I think if you think about reflect about what happens in financial markets, where the pressure to constantly make decisions, to perform effectively, in other words, to have a rate of return which is adequate within market expectations, is relentless. It's horrendously relentless, as I'm sure you all know. We simply do not have that same level of relentlessness when we start talking about having a positive impact on the environment or on social issues. It's not anything like as driven. And so it allows us as optimistic human beings to go, well, we've done a bit here, it's good, we've ticked that one, but it would not be acceptable. It's way off the level that's necessary. And so if you had that level of pressure, just imagine for a second that we were all driven as furiously around creating a positive social and environmental impact as we are currently driven by creating a financial one. And just imagine what that pressure would suddenly look like. There would be immediately an external pressure to raise up the quality of the data that was being used, because that data would now be decision relevant, would actually be driving decisions, and so everyone would start forcing it up. And I think within that, the big bit that we'll be looking at is partly this issue of the accuracy of the data, but partly the issue of, is it complete? Now, for those of you who love your auditor, the auditor's job is to assess the risk that the information in your accounts is not materially correct. In other words, something is missing, or something's in there that shouldn't be, that is going to influence decisions. There's always a risk of that, but their job on behalf of investors is to assess the risk of something missing out. And the danger, I think, when all of us, when we look at a sustainability report or we see some information in front of us, we kind of get sucked into looking at that, and we don't ask the question, is it all there? And again, one of the good things I think about the SDGs as a frame for that, they're not a perfect solution to it, but they're a frame, is, are you missing anything out? And if we have a balance then of some comfort that we've got the right stuff in front of us, and some comfort that it's stated at the level of accuracy that we need in order to make decisions, we'll get somewhere, but I think we're quite a long way away from that at the moment.
I would agree. And I think also we were discussing beforehand as well the nature of the data or the KPIs that you have. So there's quite a lot of activity, I guess, around metrics that they're activity-based, are effort-based rather than outcome. And I think what we've been discussing here is all about outcome. So with climate change, you have an outcome which is parts per million of CO2 in the atmosphere. That's your outcome, that you're trying to reduce that concentration. And then there are similar metrics for nature, the level of biodiversity or the quality of the water or whatever it might be. But those metrics need to be outcome-based, because impact investment, is about outcome. It's not about effort. So I think that's really key, thinking about which metrics you're using.
There's a lot of enthusiasm at the moment for standard metrics. Let's have the same metrics, because then we can compare things. But if those metrics are not actually the ones that you are actually measuring what you're trying to change, if you're trying to change an outcome, if you're trying to change planetary well-being or people's well-being, and you don't have metrics that relate to those outcomes, the fact that you have a standard list of some other set of metrics is not going to be very useful for decisions. Not only will you not be able to make choices between different options, although you've got this comparable data, you will not have the amount of information that drives the very insights that you need if we're going to ramp up the number of decisions that we're making in order to achieve the kind of sustainability. And it's not progression towards sustainability, it's avoiding the catastrophes which, for many people in the world, they're already experiencing. For most of us, probably not so, but I think we're all starting to notice that it's fraying at the edges. And I think it's that sense of urgency that we need to drive back into the decision making, which again, the standard metrics. Being an accountant on this is quite strange because if you are a geeky accountant, that still sticks in me that in financial accounts, comparability of the information you put into the accounts is not a requirement. It's enhancing. It's a nice to have. We'll have it if we can, but it's not a prerequisite of information to be useful in a set of accounts. So this enthusiasm for standardizing metrics feels quite strange, given if the financial information is useful for investors and doesn't need to have that comparability as an input, why are we chasing it for this other type of information when what we really should be chasing is organizations' effectiveness in making decisions where they are performing adequately. We don't want to know how much carbon there is or not. What I want to know is how much were you doing last year and how much has that changed? And is the amount that it has changed adequate? So we were talking, the need for targets on this is really important, but not just targets that are a bit more than last year, because that almost certainly isn't as much as could be done, and it almost certainly isn't as much as we need to see happen. So in the SDG impact standards, we talk about having to have ambitious targets, debate what it means by ambitious, but we are saying if we're going to avoid some of these catastrophes, we need to really ramp up our ambition and our willingness to set targets which are far more demanding.
Yeah, so, going to that, it sounds like on one level, the data maybe isn't matching when you're comparing like to like, and the other one is maybe you're not reaching for the right standards that you should be looking for when you're doing the investment. But so what is the solution? What should people be looking at? I think the problem is pretty clear, but just put you guys on the spot. So what's the best way forward on that?
I'll just get my magic wand.
Yeah, magic 8 ball.
Well, I think there is a solution. So, because I know it is we've discussed the issue quite extensively. I don't want to put anybody off from looking at this space because there's a huge, huge opportunity here if you can get it right. So, I think the data are coming. I think, as we said, the solution is to have a framework about what it is that you need to consider. So, let's say you're looking at investing in a particular company that does a very narrow, focused thing. But you need to have a framework to think, okay, well, we're going to evaluate this company and its impacts on a broader range of metrics. And even just thinking about from an E point of view, so it might not just be carbon. You need to also think about water. You need to think about biodiversity. You need to think about soils. You need to think about air. And with that framework, and there are frameworks out there, you can start to tick off some of these issues. And it might be neutral that, the company has no impact on that. That's great, but you've thought about it. So that's the first place to start. I think is having those frameworks to screen, to assess impacts. And then from a data point of view, this is what we specialize in. So we provide very, very fine spatial resolution data. I think that's really key. There's no point in having a data set which is global 1 kilometer resolution and tells you nothing about the assets that you're interested in. So having the right kind of data at the right resolution is important. But that's possible actually, and there's lots of people like us working on that. And if you have high quality data and comparable data across a range of different areas or a range of different locations, then it becomes much simpler, I think, to start your screening. And to your point as well, Jeremy, about monitoring, so that's another thing that we look at, and I think that is really important, having a consistent data set that you can then monitor through time to show either a neutral impact or a positive impact.
We're so used to being held to account in a financial ecosystem of which the audit process is part. And we accept that we absolutely need that to protect investors. And we have legislated that thou shalt have your accounts audited. And if they're not meeting the standards required, you get qualified accounts. And I've been on that side where, as an auditor, we have not been happy with a company's accounts. I've been for only just one of those experiences, and it was qualified. And the result, the consequence was the company delisted from the stock exchange. That's quite a serious consequence. Yeah? Why are we not willing to recognize we need the same level of assurance to protect people's human rights as we are willing to put in place to protect investors' rights? So I think in the end, this is a legislative requirement. We need to be saying we need company law to require assurance of the consequences of a business model on the social and environmental impacts that we have around us. That's doable if we mandate it. That's a public policy decision to do that. It's perfectly achievable, but it doesn't seem very exciting. So kind of my challenge on this is, yes, I can say we need legislation. And in the interim, while we're waiting for legislation, the UNDP's SDG impact standards, great place to have a look. We will be developing an assurance framework for that. They will contribute to raising that bar, but they will be voluntary. And so, how do we get over that? The only way you get away from voluntary is legislation in the end. And that is not very sexy or exciting. My niece is a climate activist who spends more time gluing her hands to the doors of banks. And when I try and discuss with her the need to change the audit regulations, it doesn't quite. So my challenge in this is not what the solutions are, it's how do we make them seem relevant and important enough that we kind of coalesce and start to lobby for them. So that as investors, when we look at companies we're looking at, we need to start saying, I've seen your accounts and they're audited, great. Well, what is your expected impact? And I need that audited too, I'm sorry, because if we're not willing to get that audited and start pushing for that, we risk the information not being what it says it is. And then we will not have the amount of change that we all urgently need.
And who do you think should be determining the impact? Is that company by company basis, what their impact is, what their goals are? Or do you think that should be more legislative criteria?
There are debates around that at the moment, because you're right, if you're going to say what should the targets be, it's an interesting question. Now, for some of those areas around, say, some of the climate change ones, you can go to science-based targets. So you can go, we already know, and there are ways of allocating that down to an organizational level. There are techniques out there. They're not perfect, but they're not designed to be perfect. They're designed to be much better than the alternative, which is nothing. So it is quite possible to set some targets now as an organization if you want to. That can be audited. That's perfectly possible. And in the interim, while we're working around, what should the target be for gender equality in your organization, which is one that kind of always I find extraordinary, is that what is it now? We're 100 plus years until we get gender equality, apparently. And as a result of the pandemic, it's another 30 years later. So it's 130 years until you get gender equality. And I suspect, well, how long would you be willing to wait for gender equality as your threshold?
It's already too late.
It's already too late. That's great. But to, kind of not 130 years, I assume. So it's not impossible just to kind of think, who are the group who are experiencing this inequality? What do they want that threshold to be? And well, there's nothing wrong with that. And I think that if the threshold for gender equality is tomorrow morning, then so be it. Because not to do that is just reinforcing and reiterating the existing power dynamic. So, these things need to happen. So I think you can set thresholds quite easily. I think they are auditable. They are uncomfortable at times, but that's the nature of being held to account. When our financials aren't as good as they want to be and the investors come in on the door and start giving us grief for underperformance, that's uncomfortable. But we recognize we need that system, and we just need to mirror that, I think.
It's one thing that you can do as an investor as well, is that you can request that the companies that you're engaging with are very transparent about their impact and their targets on impact, and quantify that. We were looking before about the historically what has investment been able to achieve, and the returns from that, and how exciting it is to be in this space at the moment. But there wasn't much on what impact has there been in physical units, or in quantifiable units, what has been the impact. And I think that's where you can start to demand.
Still, there's so much money. We talk about 33 trillion in ESG, and tell me how much impact that's had. Well, we don't really know. Okay, that's like. There's a positive as well, I think. The European Community is going through its process of developing a new corporate sustainability reporting directive, as most of you will know, and that is likely to require some form of audit this time around. Last time, it was voluntary at a national level, and so some countries did it and others didn't. This time, it's much more likely that it will be mandatory and will probably affect around 50,000 companies directly. But I think a lot of others will follow that, and or it will affect their supply chain, so it'll be a larger number. The debate then is what is being assured. You know, if there's legal requirement, if it's a kind of, have you got a list of indicators, tick, that's very different to, have you thought through what the right things were, audit. So that will become a bit of a debate. And I just think it's important that for anybody who thinks that we need to ramp up that level of expectation, then we get involved in that debate as it starts to happen and make sure that we get a good outcome for it. It's an opportunity here, I think, to start to put something into regulations and legislation at a level that could be effective and could seriously shift things. There will be pressure, I'm sure, for it not to be too demanding, because the people making those decisions are generally not the people who experience the consequences. They're generally not in the room, having a voice. And somehow we need to act as if they were in the room when we're lobbying for that new audit regime to be effective.
That's great. And then I guess we wanted to open it up if anyone had any questions for the panel. I think there's a mic available if anyone has any questions.
Yeah, question over to your left.
Oh.
We have no answers.
You have good eyes.
Hi, just a question on the auditing and defining the standards for auditing the impact of investments. I'm speaking with friends who are working in this sector, and they are saying that it is difficult to define these standards at the moment. And using your analogy as to how financial accounts have to be audited, what has happened before the standard of auditing has been created? Would that be a path that could be followed here as well? And if that is, can it be accelerated?
Yeah. I mean, it's 1971, I think, was when we first got international accounting standards. So it's only 50 years ago, and we're struggling to catch up on the impact standards on that. And actually, there's a lot of convergence around that happening, so that's kind of okay. The audit historically came very slowly as well. Originally, it was just one of the shareholders was given the job of doing the audit, and that then became an independent function as the limited liability company required it. I'm going to drift slightly into geek land, I suppose, because the International Accounting and Auditing Standards Board does have guidance on how you would audit what they call extended external reports, but they specifically refer to impact and sustainability issues within that. So they are working towards those. And I think if we wait until there's the kind of perfect answer, we'll be waiting forever. You know, it wasn't, I think it was 2000, I think, was the change for mining companies when they did not have to account for the future closure costs of a mine. So as an investor, you know that there were these mines, but you wouldn't know how much it was going to cost to close them when that time came. And that was deemed to be not good enough information, so they said, okay, go out and start putting that information into your accounts. And everyone went, well, we've no idea. This mine is closing in 50 years' time. How are we supposed to tell you how much it's going to cost to close it? And should we include the environmental costs of closure, for putting it back? And what about the social consequences? Should we do all those? And everyone went, don't know. You have a go, and all the mining companies will get audited on this new information. And hey presto, within a year, 2 years, that was standardized because there was a massive community of practice. So driving it by what we needed as investors led you to the standardization that we needed. If we do it the other way around, we'll be waiting forever. If our starting point is we need to know whether these organizations are creating a contribution to sustainability or moving us away from it, go and do it, then I think we would quite quickly have a massive community of everyone working that out, and we'd solve it.
Last question, please.
Great presentation. I really loved kind of your thinking. A question I have is, do you think there's a perception problem with impact, specifically given that in very basic terms, everything is measured on investment return? I mean, the economy runs on numbers, on spreadsheets. Yet, obviously, the younger generations that are coming in, they're moving much more into having, obviously, more sustainable views and control, but there's still a problem. We're looking at balance sheets. Well, people are looking at balance sheets, at numbers, impact. There's just a clear misunderstanding, and unless there's a common standard globally, where are we going?
Again, it's the same issue, I think. We're going the wrong way round. And what the focus we've taken in the SDG standards is to say we're going to look at your decision making. The first thing we need to know, before we look at how much you've had or not had, is whether you are making decisions at the rate and quality that is necessary, And that's our starting point. If we had that ecosystem, you would then result with performance data that would be more meaningful. And if we go that the other way around, we do have a bit of a problem on that. That said, there are still, I think, convergence around organizations that are thinking this through in terms of the performance. Organizations like the Capitals Coalition, for example, have approaches to doing that. I sit on the board of a company that yesterday, it's small by the scale of businesses I'm sure you deal with, it just scrapes into the medium, it's turning over 12 million. And we have, for the last couple of years, not only have our financials, but we also have an impact budget, which we set in quantitative terms. We actually set it in financial terms, but it didn't have to be, but we do set an amount of impact, and we have that as a budget. And our financial returns are coming in at something like 2 or 3% at the moment, and our impact returns are coming in at about 20%. And our conversation is, what should we be doing next year? That's our stuff. What's our impact budget? Now, we've done that for our internal decision making, and it wouldn't necessarily be comparable with everybody else at the moment, because we're still moving to an ecosystem which would drive comparability not of metrics, but comparability of the decision making processes that would result in that. So in the meantime, whilst we don't have that, the important issue is, are we, as a business, making decisions against that? And how are we thinking that through so that the investor looks at that? And we could give you those figures, and you may not agree with how they're put together, and we go, that's nice, but we're using these to influence our decisions. We have inflected our strategy, the way we drive our enterprise value proposition, that all the way through the business is becoming now affected by that headline metric of 3% financial returns, 20% impact returns.
No, I think I just...
Yeah, I think
Oh, I'm sorry, Becky.
One more. Sorry.
I'll be really quick. Well, just to add to that, make to the point that this is exactly what the capitals approach is trying to fix or trying to solve, is that if you take a capitals approach, you bring those elements onto your balance sheet and your decision making. So natural capital sits alongside your financial capital, and you have metrics for both. And I think once you get to that point, that's when your decision making starts to take account of everything.
Thank you. Thank you.
Thank you, guys.
Let's give everyone a big hand. Thank you so much.